A sudden escalation in the Middle East, strikes on Iran followed by retaliatory attacks on energy infrastructure in Saudi Arabia and Qatar, has rippled far beyond the region. Markets are reacting fast because energy sits at the center of the global economy. When oil and gas supply looks threatened, prices move immediately, and those moves flow into transport, food, inflation, and financial markets within days. First, fuel prices at the pump, with Brent crude already up around 9%, petrol and diesel typically follow almost immediately. Next, utility bills. Threats to Qatari gas facilities can spike global LNG pricing, pressuring heating and electricity costs, especially in Europe and Asia. Food prices often follow, because fertilizer relies on natural gas and shipping relies on fuel. Finally, investors rotate into safe havens like gold, the US dollar, and the Swiss franc. The downside shows up in everyday spending and corporate profits. As households spend more on energy and groceries, disposable income shrinks, hitting dining out, electronics, and luxury goods. Airlines and travel also suffer. Jet fuel is a major cost, and higher ticket prices usually reduce demand. In markets, non-energy sectors like tech and manufacturing often become less stable as operating costs rise. At the macro level, persistent energy spikes act like a global tax, dragging on GDP growth. Volatility creates winners as well as losers. Oil-exporting nations outside the immediate conflict zone, like the US, Norway, and Guyana, can see a revenue windfall when prices surge. Defense contractors often gain from increased procurement of drones, air defense, and munitions. High fossil fuel prices can also make renewables and nuclear more competitive, accelerating investment. And commodity traders, especially in futures markets, can profit by positioning for sharp price swings. The key pressure point is the Strait of Hormuz. About 20% of the world's oil flows through this narrow corridor every day. If shipping is disrupted or blocked, today's 9% jump in crude could double, and the odds of a global recession rise sharply. To go deeper, we can map the impact on a specific economy, like India, or list the most exposed industries in global stock markets.